Hey, welcome everybody. Welcome back to the 90-day commitment. We are on week 11. So if you are just joining in today, make sure that you check out all the other videos because there's some really great nuggets in there. However, if you are just joining today and you're really interested in just the investing in yourself and investments, protecting yourself, you are on the right week. So my name is Angie and Shay is joining as well in order to put this great series together in order to help educate you so that you can build a better foundation so that your future is stronger and brighter. So today we are talking about investing in yourself, building wealth, and protecting your health. So today we are going to cover foundations of building wealth. We're going to talk about risk management, understanding the market. We're going to talk a little bit about segregated funds, diversity, and how to protect your health. Now, we like to start this off by a little bit of a disclaimer. The purpose of the presentations that we do are to explain financial concepts and to educate people about the decision they're going to be making with their finances. It's not intended for any sale or suggestion of financial products, but rather to illustrate probable outcomes of these scenarios. So during the presentation, we ask that you don't take any pictures. And that is so that we can preserve the integrity of this information. Feel free to write any notes that you want, ask any questions, put your comments, your questions in the comment area below. Make sure that you like, subscribe, click that little subscribe button so that you get notice of any future videos that we are putting out. We want to be able to interact with you. So like, subscribe, and write down any questions if you want in the comment section. We also have in the description area, we have our contact info so you can get in touch with us. All right, so building wealth. How do we want to do that? Well, we talked in our last presentation about knowing your FIN number. So I'm not going to touch too much on that, but just as an overcap or an overview of that, to recap rather, is just to know, what age do you want to retire at? How much do you need to retire at that number? Will your current financial plan allow you to retire there? Do you have a financial plan? If you don't, you're in the right spot. Now consider this as you're creating or thinking about that plan. Now, we consider ourselves kind of that builder or that consultant. Now, consider if we were building a house, because that's what we're doing, is we are building your financial house. Now, you're building a house and you've gone to, your building contractor, and they're like, okay, yeah, absolutely. You've told them what you want. They've looked at it all. Absolutely, I can help you out. Now, as you started out, they start building from the roof down. And you kind of look at them and go, not so sure about this. And you're like, would you think that your house is going to be able to withstand the natural things that weather brings along, or even just settling? Well, do you think your foundation is going to be strong enough? Do you think you're going to weather that storm? What's going to happen when the rain comes? I would be a little concerned myself, actually. Now, that's the same approach that a financial advisor or educator has as well. You want to make sure that your foundation is solid so that you have that foundation so that everything else is firmly in place. So we start off with protection. Then we look at debt management. look at an emergency fund, and then look at investment so that your foundation is able to withstand all of those things. It's not the greatest thing if you're going to look at investments if some of these other things aren't in place first. So our formula starts with money. Yes, the all-important M word. You add time, then you look at your rate of return, less inflation, less taxes, and that's your wealth. So we look at time in the market, not timing. So we focus on a buy and hold for the long term. If you're looking at investments and that type of thing, because if you are looking at short term, there's a very different process than if you're looking at the long term, because you're going to be going in, and over the long term, there's going to be dips and there's going to be high points, low points. There's going to be all these little hills and valleys that happen. But overall, that's the picture that you want to look at. Investors often make the mistake of trying to time the market by simply selling out of it. Historically, though, some of the worst short-term market fluctuations and losses were followed by periods of the substantial market recovery. So when the market dips, that's when you want to look at getting in, because you're going to be getting, it's like a sale. You go to say Costco, or you go to the grocery store, you go to your clothing store, and you're looking at when the sales happen so that you can get the best deal. Well, that's what happens. So you look at the market when it dips, that's when you want to buy in. Asset allocation, diversification, periodic rebalancing, these are all tools that investors use to help weather the market downturns. Having the right investment mix also helps strike the right balance with risk and return. And that's something that we as advisors and educators help you learn, so that you're not freaking out when you see, oh my God, the market is flailing. So that's when we expect you to give us a call. We don't want to stress you out. We want you to give us a call so that we can take a look at that long-term market and say, okay, yeah, we've seen that, and this is what we are expecting to happen. If we've done our job right, we are putting you in a market, in a diversified enough market that these dips that are happening are not going to be affecting you as harshly as if we put you, let's just say that we look at your risk tolerance and look at the diversification that is best for you. So when's the best time to start then? Well, obviously it's best to start, like say 20 years ago, but we can't do that. We can't go back in time. We don't have that DeLorean that Marty McFly had, right? So we got to start where we're at. However, if you are, say, 35, wherever you're at, you can start. It's just know the difference. So if you're a younger person, now I say younger in relative to me. So if I'm talking to Shay, we're gonna have Shay maybe take over from now, because my dogs want to take over.
The dogs are getting a little too excited about the rate of return. That's okay. So like Andrew's saying, it doesn't matter when you start. One of my favorite quotes is, the best time to build a tree was 10 years ago, but the next best time is today. So this just gives you a little idea of what happens when you start earlier. So if you're already in your 50s, maybe talk to your kids or any younger influences you have and tell them to take advantage of the time that you may not have for yourself. So with the same initial investment of just $100 a month at 8%, at 35, starting to do the $100, by 65, you would have $150 in the account. If you started doing the same thing at 50, you would have around 35,000. So the idea is just the longer you wait, it doesn't mean that you're behind. It just might mean that we have to do a larger contribution on a monthly basis to catch up, and fairly so, because that person had been investing for a longer period of time. So it just to beat that average out. So with the rule of 72, this is kind of the golden rule when it comes to investing. So if you take 72 divided by the rate of return, then that will tell you how long it's going to take for whatever amount of money that you've invested to double. So if you're at 12%, you're about 6 years for your money to double, 10%, 7.2 years, and so on. Now, the sad thing is that a lot of people are going with rates of return below 4%. I think even Angie can testify to the clients that she's had that most of their rates of returns have been around 1%, 2%. Some are lucky to have 7. But ask yourself, how many times is 20 years going to come around before retirement for you? And how much is in that account that would it doubling last? Would that reach your FIN number that you calculated the previous week? Probably not, typically. So we need to do our best to find the highest rate of return possible. Angie and I can help you with that. We do work with investments. We work with the top tier financial management companies that can usually average around that 12 or 10% range. So that gives you a good return on your investments. So this just gives you an idea of what 4, 6, and 12% would look like at 65. So by 65, if you were doing 4%, your money would be doubling only 3 times until 65, leaving you with 40,000. If we go all the way to the 12%, it's doubling 1, 2, 3, 4, 5, 6, 7 times, which gives you a substantial difference as far as rate of return, $600,000 more at the end of your retirement years. And of course, that makes a big difference as far as all the goals that you can cross off your list with that investment. Now, Angie was telling you the equation for wealth. One of those was inflation. Now, unfortunately, inflation has not gotten better. I don't have better news for you, but inflation typically is 2.27%. That's what it was in 2018. It ranges between 1 or 3% per year, but as of the recent years, it actually has gone up past 3%. We're looking more around 4 to 6% this year and next year, which makes these numbers a little more scary. And that just means that we have more work to do as far as combating inflation and beating inflation. So if you ask your parents, or you even think back to when you bought your first home, how much was it? It might have only been 150,000, maybe 170,000. To get into a house today, you're looking at 400,000 minimum, typically, to get a single dwelling home. So that just shows you how little or how much your buying power with that $100,000 that you might have is dwindling. A new car might have only been 16,000, and now that same new car would be 30,000. A loaf of bread, maybe you can remember a time where a loaf of bread was maybe $1 or $2, and now it's $3.25, right? I don't know if you've noticed going grocery shopping and you grab things being like, oh, it'll be about $100 or about $200, and you get up to the till and they say $325 or whatever, and you're like, what, for 3 bags of groceries? And you're wondering, what is going on here? That is inflation. So that just shows you that buying power is dwindling over time. So we need to combat that through investing. So you don't need to worry too much about the math. I won't hurt your brains too much, but the idea is that if inflation is 3%, then we need to be getting at least 4% as far as a rate of return to keep our buying power and to keep our money keeping up with the rate that our buying power is dwindling by. So what this shows is kind of goes over what Angie was saying, how there's going to be hiccups in the market where we see our money maybe go down a little bit and then go up and then go down and then go up. But overall, the money is on an incline up. And that's what choosing a good, strong investment will do, is give you that peace of mind, even if you have big dips in the market like this one around 09, 010. You're not going to have to worry that this is going to be a long-term scenario. Because if you think about companies like Facebook, like Amazon, like Logitech, Pfizer, these companies, even if you see them going on sale or dropping, it is like it's going on sale. You know that that company is going to be around forever. It's just a moment in time. So really you should be getting excited because you get it at a discount. Just like if you go to Winners or Macy's or the mall and you see 50% off signs, you're not like, oh my goodness, the mall is closing. Oh my goodness. No, of course not. All you're going to do is you're going to say, okay, everything's on sale. Let me shine up my new credit card or let me grab some cash and I'm going to go shopping. So types of investments. You have a tax-free savings account, which is a registered savings plan. We touched on this last week. This is for typically your emergency savings fund. And then you have your RRSP. This will be for your long-term investments. This will be for retirement. You have your RESP. This is where you can save for your kids' education. And then you have your non-registered investments where if you've maxed all three out, you could, you can start investing here. So different types of investments that you can go into. You can go into cash, GICs, bonds, stocks, ETFs. There's such thing as mutual funds. Sag Funds is what I wanted to talk to you about today because they do have some very special benefits. And then there's also many more that you can go into. So what do I invest in? So in those accounts, there's a lot of different places that you can invest. You can do actively managed portfolios. You can do index funds. You can do ETFs, or you can do target date funds, which fluctuate as you age. How do you know what to choose? Now that is based on your risk tolerance, and having a financial advisor or somebody who can just go through the options with you and help you decide what best suits your needs and the purpose of the investment can really help. Stocks are typically for growth. Bonds are typically for safety. And then you have other asset classes that can help just diversify your portfolio. What is risk management? So a common definition of investment risk is the deviation from an expected outcome. We can express this deviation in absolute terms or relative to something else. So while a deviation may be positive or negative, the investment professionals generally accept that there is going to be some form of deviation from the expected outcome. How much volatility, an investor should expect is entirely dependent on a risk assessment. So typically before we do any investments, we do a risk assessment with you. We just kind of figure out what you're comfortable with seeing as far as fluctuations in the market. So how do you capitalize on these dips in the market if you don't know when they're going to be? So the best way to do that is to dollar cost average. So this way it takes the guessing work and the assumptive work out of investing. You just make it consistent. So how dollar cost averaging works is you simply pick an amount that you can comfortably invest on a consistent basis, and then you automate it. So every week, bi-weekly, monthly, quarterly, annually, you can pick an amount, and then it will always buy into the market. Sometimes you're going to get a sale where the shares are down, or you're going to be buying it at a high, but it always averages out to being a decent price. So how do you make investments less risky? And that's through diversification. So imagine riding up an elevator, and the elevator is held up by a little tiny cord, just a little tiny frail metal cord. Would you feel comfortable riding up that elevator 20, 30 floors? Probably not, right? So what you want to do is you want to have your retirement plan have multiple cords that are carrying you up. So if one doesn't work out, you still have multiple other ones that are going to be carrying you up to your end goal of floor 65. So the more that you have that's going to be carrying you up there, then if one's fluctuating and one's doing really well, then they'll balance each other out. So if we're looking at asset allocation and diversification, this is kind of what we would look at as far as if you're very conservative or if you're aggressive. If you're aggressive, we look more at equities and stocks. If you're wanting to be more conservative, we look at fixed incomes and cash. So we can customize your portfolio to suit your risk tolerance. What is a seg fund? So seg funds are what we in the insurance world work with as far as your investments. Seg funds, like mutual funds, are a market-based investment. It's a large pool of money. It belongs to many people who are all investing in stocks, bonds, and other securities. It's a pre-made portfolio typically as well, with the goal of increasing the value of the entire pool. However, because seg funds are provided through insurance companies, they have special benefits that mutual funds do not. So seg funds can guarantee up to 75 to 100% of your premiums, less the withdrawal. And when the contract is mature or on death, that is available. Some seg fund contracts also offer income guarantees. It would just depend on the seg fund, so we would go over that if that applies. Many investments in seg funds are also protected against seizure from creditors. So whether it's bankruptcy, they'll provide creditor protection. This can also be a big advantage if you're a business owner or professional wanting to protect against unexpected lawsuits. You can consult your tax or legal advisor for details on if you apply for this. Seg funds are purchased with non-registered money. You can also name a beneficiary, which is an amazing asset because that means it bypasses your estate and goes directly to them. So less taxes are being removed from the money that you've earned. Now, because it's being managed by somebody else, you're going to have a professional money manager. So there are such things on the seg funds as management fees. So what this does is it covers the operating costs, such as the cost of hiring, retaining investment advisors who manage the funds and the investment portfolios, and other management fees not included in the expense category. The average MER fee in Canada is around 2.53. It's important to note that all rates of returns are published net of fees. So if you see a return of 10% and there was an MER of 2.5, that means that the actual return was 12.25, but they already removed the MER fees to show you what your rate of return would be. So when you're investing, regardless of if we went with your risk tolerance or not, there are going to be a range of emotions that you may experience. So at first, you're going to be excited. It's the best decision you've ever made. You're excited to watch it grow. This is an amazing start. But then you will experience those little dips in the market, like we mentioned, where you're like, uh-oh, what's going on? I got to call my advisor. What is going on? All my money's gone. Oh no, this is it. I've lost it all. And then it goes back up. Okay, this is more like it. Glad I stayed the course. Never had a doubt. So we're here for you in the low times. We celebrate with you in the high times, but know that these fluctuations will happen. And on a grand scheme of things, these fluctuations are going to seem like minor hiccups in the market, but in the time when we first go through it, of course, it is going to be a roller coaster. There are going to be 3 phases of wealth. The first phase is going to be the accumulation phase. This is where you're in your working years and you are accumulating your wealth, you're building your net worth, and then it goes into the distribution. This is where maybe you have a family, you're sharing your wealth with others, and then it goes into estate transfer. This is when you pass and you're transferring it over to the next generation. So we want to make sure that you have a plan for every single phase, and you also have a backup plan to stop you from maybe being just about at the cusp of going into distribution and falling all the way back down to the very beginning. So how do you build and generate wealth? And how do you build generational wealth? The best way to build generational wealth is to take advantage of the wealth cycle process. A major component to that process is protecting your ability to earn income in the accumulation phase. Now, this is typically done through insurance. Insurance is a tool to reduce financial loss or hardship. It is a contract between an insurer and the insurance provider under which the insured can be paid for any uncertain losses, and the insurance provider pools the client's risk to make payments affordable for the insured. It is a protection that can help cover the cost of unexpected events such as theft, illness, property damage, or death. The protection or coverage you receive can be for a limited period of time, or it can be a lifetime coverage. In return for the protection, all you do is pay a premium. The premiums are the amounts you pay on a periodic basis, depending on the type of insurance and what is stated in your policy. The amount of premiums that you pay is going to be based on the probability that you will suffer a claimable loss. Other factors that are considered to commute premiums can be the insurer's age, health, lifestyle, and family history. Now, the cool thing about insurance these days is most of them have return of premium. So now if you don't claim, you actually receive some of your premium back, which is an amazing feature that a lot of insurance companies are adding on to their products. So through being an Experior partner, which we talked about in the business video, we have partnerships with all of the major insurance companies, as well as some that you may have not heard of. And we do work with most of the major banks. So we have lots of options as far as what we can offer, and we can almost always guarantee one of the lowest prices in the market. What is your biggest asset? Now, I'm sure you're thinking, oh, it's my house or it's my car. Well, really, it's your ability to earn income and pay for all of those things, as well as your health, which gives you the ability to work. So I'm going to be going over a few insurance products that you may want to look into or check if you already have, because I think that they are very, very important in creating your stability in the accumulation phase. So the first is health and dental. In Canada, your provincial government pays for most of your major medical expenses, but not all of them. So prescriptions, as well as dental care, eye care, and most mental health related expenses are not covered. Many employers will offer health and dental to help fill the gaps, but some benefit plans require employees to pay a premium, while other employers will cover the premium costs. So it really depends on the employer and what company you work with, but I would recommend that you review your coverage and make sure that your family is adequately protected. If you're self-employed, you probably don't have any health and dental packages, and you may have not known that you can purchase it individually just for yourself. So if you don't have health and dental, you can touch base with Angie or myself, or you can do your own research and look into some health and dental options for you. Travel insurance is another one. Now, sometimes it is included in your health and dental plan, but in Canada, we are only able to access medical coverage within our home province across the country. But there's certain medical costs that can be claimed only once you've returned to Canada after traveling abroad. Many medical costs aren't covered when you are actually traveling. And even when they are, you are typically required to pay upfront. So if you have insurance, the insurance will pay, and you won't have to worry about any unexpected expenses coming out on your trip. If you don't have insurance, you would have to foot the bill, and nothing puts a damper on a vacation than like having a $1,000 broken limb bill for medical that you didn't plan for. Many credit card companies include travel insurance, as well as, like I mentioned, health and dental policies cover travel insurance as well. But I just want you to check on if you have that coverage. Now, living benefits. I know these stats are not the best to look at or to think about, but it doesn't change the fact that they are the stats. In Canada, you have 1 in 2 Canadians, 49% of men, 45% of women that are expected to develop cancer in their lifetime. So if you look to your left, you look to your right, one of them will go through a cancer scare in their lifetime. 1 in 3 will be stroke victims under the age of 65, and 1 in 2 will be a heart attack victim. So what would you do if something like that happened? What is your plan? Do you have enough in your emergency fund to not set you back for your accumulation phase? A lot of us own life insurance. We understand that concept. That concept has been drilled in. But what would happen if you don't pass away? What would happen if you survive? This is an insurance product that can be difficult to qualify for, and it can get pricey. But I do recommend at least checking to see if it's in your price point, and really asking yourself if you have an alternative. If you don't have this and that happens, what is your alternative? This is also a product that does usually have ROP options. So if you don't use it, you can get your premiums that you paid back for it. You are guaranteed to eventually pass away. You're not guaranteed to get sick or injured. If you do get sick, or if a loved one gets sick, you can't work. You will need money to offset financial loss. You may also need money to compensate the person who's going to be taking care of you. And whatever associated costs come with care for and management that loved ones will have to do for the ill loved one. It could be childcare, it could be respite, it could be medical expenses, it could be well above and beyond what our medical system is going to cover. Critical illness can help offset the cost. Critical illness pays a lump sum fee, lump sum amount, tax-free, if you survive the diagnosis of the covered condition for 30 days. And typically it's between 16 to 25 illnesses that they cover. Disability. Now, although life insurance is widely understood, like I mentioned, many people don't realize that the odds of experiencing a disability are actually substantially greater during your working years or your accumulation phase than the odds of passing away prematurely. On average, regardless of age, whether you're 15 or you're 50, the odds of having a disability is 20%. So ask yourself, if you were suddenly unable to work, if you could not afford to be able to do any income producing activities? Could you afford to self-finance the cost of your treatments? Would you be able to keep up with your investments? Would your retirement plan still be able to move forward? Probably not is typically the answer. So there's two different options of what we can add for disability. There's a short-term disability. This could cover you for up to 6 months. This is if something is not a lifelong disability. This can sometimes be covered through your employer, so check with your work and see if there's any options to add that on. And then there's also long-term disability. This type of insurance is usually will come in after the short-term runs out. This is also once your EI and sick leave benefits have been exhausted, this is your kind of your last kick in. Your long-term disability plan will differ, but most will pay from 2 years once you have left your work. After 2 years, it will only continue to pay if you've proven that you're unable to work at any job. If you're looking at disability, it covers you if you are sick, injured, or having any way where you cannot do your regular functions at work. It will cover 60 to 85% of your net income. And if you are a business owner or self-employed professional, you really need to ask yourself and put an importance on having disability, because you won't even have EI to fall back on. As a self-employed individual, you don't pay into EI typically. So this is your EI plan. So you would definitely need disability because you are your job. So if anything happens to you, your income is gone. I will be talking about life insurance in the next week, in the last week of our 90-day commitment. As this kind of falls under the wealth transfer portion, the creating wealth for the next generation. I wanted to go over how to protect yourself in the accumulation phase before I talk about distribution and estate transfer phase, which is where the life insurance falls into place. So how do you get insurance? There are a few places or individuals that you can seek out. A financial advisor, which is like myself and Angie, would be taking the holistic role. We view your finances, your lifestyle, and your goals as a whole, and then we help you provide and achieve the right protection to get you to where you want your lifestyle and your goals to be. So we really do a generalized focus on insurance, and then also do your investment planning as well. You could go directly to an insurance broker. Their role is to review your current situation and strictly focus on the insurance and the best insurance that you need. Or if you know a specific company that you want to work with, you could go to an insurance agent with that company, and then they would be well informed on the products and services that that company offers, and they would be able to cater a plan that would best suit you based on what is available with that company. In summary, I just want you to remember, just have a plan. People don't plan to fail, they fail to plan. Build a strategy for how you're going to reach your retirement, and make sure that it's a fail-proof strategy. Learn wealth concepts and use them daily. Consult a financial coach regularly to make sure that you're on track to reaching the goals that you predicted for yourself. Budget around how much you need to invest and make it consistent. Automation is key. Manage your risks, diversify your assets, and make sure that your elevator to retirement has multiple cords carrying you up. Make sure that you remember that you don't need to stress about the market. Let your emotions go, and just know that it's time in the market, not timing the market. So just stay consistent, stay motivated, stay focused, and just keep with your plan, and everything will be fine. Remember that your health is your wealth. and your ability to work is your biggest asset. So please make sure that you protect it. I want to thank you so much for joining our 90-day to commitment. Please like, comment, subscribe. Let us know as we are coming to the end of our series what topics you would like us to cover next. Until next week, bye for now.